My name is Jeffrey Kennedy and welcome to Trader's Classroom. Today we're going to be talking about trading, specifically entry technique. And the reason why is because a good question to ask is when you're working with a wave pattern or a candlestick pattern or even a technical indicator or oscillator, at what point does a trade become a trade? When does it become truly actionable? Well, we're going to be discussing that in today's episode. But before I begin, I would like to offer a disclaimer, and my disclaimer is very simple. If you trade, you can and will lose money. And if you're not careful, you can lose a lot of money. So let's begin with today's lesson. Now, if you recall, we were working with this price chart last week. We were looking at actually examining the ending diagonal here at MasterCard. And the actual implication of this pattern was a sharp resolution to the downside that would actually fall back to below the origin of the pattern. So we've actually seen that. I do believe the move to the downside is unfolding as an impulse wave, so I'm looking a little bit lower here. But rather than focus on what I expect to happen, I really would like to spend some time here on this structure and actually, again, go back to the idea or ask the question, when does a trade truly become a trade? What would signal this becoming an actionable trade setup? Well, the answer to the question is very simple, and I base a lot of my work on that, and I've mentioned it numerous times in commodity junctures as well as in Trader's Classroom, confirming price action. How many times have you heard me say that a wave count is just a wave count until it is confirmed by price action? So we're going to walk through a number of different techniques and a number of different slides which show that main principle, the confirming price action. First and foremost, we'll work from an Elliott wave perspective. One entry technique would have been wait for the extreme of the fourth wave of the move. This is our ending diagonal, waves 1, 2, 3, 4, and 5. You could have entered here on a break of this low, and then at that point, your initial protective stop, of course, would become the actual high. Another technique would have waited for the prior swing low, this level, to have given way before doing anything. Or if you're even a little bit more cautious, what you could have done at that point is wait until you actually have your initial 5-wave decline in place. This would be your initial wave 1, and then wait for wave 1, the extreme of wave 1, to give way. So you could have been either short here with a stop at the high, short on a break of this level right here with a stop at the high, or short on a break of the extreme of wave 1 with a stop at the high. You also could have simply waited for a break of the 2-4 trend line. That's something that I mentioned in some of my webinars. But bottom line, what you're doing with this approach is you're looking for the market to go down, and you're waiting for the market to go down to confirm your assessment. A great example or a great analogy I sometimes use is, when is the best time to get out of the water if you're swimming? When you see a shark fin, very simple. Confirming price action. When do you go short? When prices are moving your way and confirming what your analysis actually says about the market. This way, you're not simply going 1, 2, 1, 2 to the upside and going, okay, hey, this market's going to explode, and then it's a failed wave count. Again, a wave count is just a wave count until it is confirmed by price action. So really, this level or this level or this level all would have been appropriate. And again, they're all based on the idea of confirming price action. I want to see the market move my way, or another way to put it is, I want the market to commit to me before I commit to the market. Now, another way we can actually work with entries here on the short side would be the bearish engulfing patterns that were evident on the daily price chart level. Here, we have a nice bearish engulfing pattern, so you could have a sell order in place at the low of the candle here, or low of the shadow, and then it triggered. Here's your initial protective stop. Here we could do the same thing again. Wait for that low of the candle to give way, take your short position, and again, the high of the candle is going to be your initial protective stop. Now, this is a daily price chart, so there's a lot of risk between this low and this low. That's something else that you need to determine on your own. Your risk tolerance is going to be different than my risk tolerance, and that's going to be different from your neighbor's risk tolerance. How you trade, it's a very, very personal endeavor. So these are one of the things I do recommend in many of my seminars and webinars, is initially define who you are as a trader. What markets do you like to trade? What's your trading time frame? These are all very important questions to begin with, rather than find out or try and figure out along the way. Now, another thing that you can do with candlesticks is also go to the intraday chart level. Here was another opportunity. We had that bearish engulfing pattern that represented actually the culmination of the ending diagonal. Here was our wave 1. Here's our wave 2. Notice, again, we have a bearish engulfing pattern on the 2-hour price chart. So you could have actually taken the short position here on a break of that low with an initial protective stop actually at the high of the bar. So what you're doing here by working with intraday candlesticks is you're definitely decreasing the risk on the position. So my risk is actually this area right here, versus if we go back and take a look at the daily price chart, then the entire range of that daily bar would represent my risk. Now, another technique that we can utilize to enter the market would be, okay, number one, we have that bearish the ending diagonal here, utilizing our Elliott wave analysis. We also have a number of bearish engulfing patterns on the daily chart level. Well, what we can then do is actually utilize, say, an indicator. Here's a good example of RSI pushing up into RSI bear market resistance, and then notice the blue line that it crosses below the black line. We could have actually utilized that as an indicator to actually go short. And that would actually represent that gray bar. Well, where would your initial protective stop be? Well, at the high of the bar right here. Again, what you're actually doing is limiting your risk. So there's really not a wrong way or one best way, and that's probably the most important lesson. Well, actually a couple of important lessons for today. Number one, know thyself. Who are you as a trader? What markets do you like to trade? What time frame do you like to trade? The importance of confirming price action. That was probably the single best piece of advice I can offer, because by doing that, looking for that confirming price action, it gets you away from picking tops. It gets you away from trading what could happen versus trading what is actually happening. In fact, you can actually say your retail traders or your amateur traders tend to trade what could happen. Your professional traders, on the other hand, they are trading what is happening. There's a big difference that I actually may discuss in a different, in the future in a different webinar here. But bottom line, look for the confirming price action. There's not a single best way to actually enter a trade. There's only your way. What works best for you, and what takes into account your risk level, the markets you trade, the time frames you trade. But here are just a few ideas on actually how you can take your analysis and find that and define clearly, not gray, but clearly define what the appropriate and actual entry technique would be. So this is how a trade becomes a trade, confirming price action. Here's one piece of evidence I can look for. Here's another piece of evidence I can look for. And also, finally, we can go back to our original price chart here, wait for a break of the extreme of wave 4 of the pattern, prior swing low, 2-4 trend line, or even the extreme of wave 1. Again, there's not a single best way. There's only your way. But never forget what we can do, as I mentioned previously. If you trade and you can and will lose money. And if you're not careful, you can lose a lot of money. This is why, as traders, we're always doing that one most important thing every day, and that's managing risk. Have a great day. I'll see you later.